Hello, this is Rebecca Bennyworth. This session for Tolley Seminars Online looks at the anti-avoidance measures announced as part of the Budget 2014 and some of the ones announced in the autumn statement that have been referred to in Budget 2014. Although not specifically labelled anti-avoidance, I'm going to look first at the property tax measures which were originally launched a year ago, aimed at properties in excess of £2 million. The regime comprises three elements: an SDLT rate of 15% on the disposal of a property with the relevant value to a non-natural person, usually a company, in order to use the enveloping system to minimise future SDLT charges. Secondly, ATED, the annual tax on envelope dwellings. This is an annual liability which requires the return and payment at the beginning of the year to which it relates, so 1st of April and 30th of April for the return. There are a number of reliefs and exemptions, and for example, property which is let on a commercial basis is not subject to the rules, although because it is a relief, owners still have to make a return and claim the relief. And the third element of this system is capital gains tax on disposal of the property at a flat rate of 28%. The Chancellor announced that he will extend these three regimes to properties worth down to a value of £500,000 over the next couple of years, and this is anticipated by the Revenue and the Treasury to raise quite substantial amounts of additional tax, although there is some doubt as to whether the projections hold valid because of the underlying assumptions. So for SDLT, the change affecting properties down to a value of £500,000 started on budget day. So for relevant transactions, that is completions, on or after budget day, if you are buying this as a non-natural person, again most commonly through a company, then the SDLT rate will be 15%. For these properties coming within ATED, it will be done in stages. So from April 2015, properties valued at £1 million will be brought within the regime. And then from April 2016, the value will be reduced to £500,000. It's not yet clear from the information that's available when the valuations will be taken. As with the £2 million values, the value date was set at April 2012, with a revaluation coming in April 2017. It would make sense on these new properties to at least align the revaluation date at April 2017, but the base date value isn't yet clear. Moving on, what we next have are some changes affecting users of anti-avoidance schemes, and these changes comprise quite a substantial package of measures. Let's just start with one area which has been the subject of a number of Tolley seminars, and that is the partnership tax. Although there have been lots of responses, including one from the House of Lords, advising that these measures are held back pending further discussion, debate and consultation, HMRC have pressed ahead with the measures. They will raise very, very substantial amounts of tax and national insurance, and therefore it's no real surprise that HMRC have decided to move ahead, or indeed, in fact, the Chancellor, because the numbers are so substantial. Turning to venture capital trusts, we have a couple of bits of tightening up of the rules, looking at the return of capital and also extending some tax recovery mechanisms to allow the tax to be recovered on VCT investments when the shares are sold within a 5-year period. Current time limits might preclude HMRC from recovering that tax at a later date, and so they will be changed. We've also got a number of developments around what are termed high-risk promoters. High-risk promoters will be notified by HMRC that they are regarded as high risk and will be required to provide significant amounts of extra information about the schemes they have sold and who they have sold them to, or face very, very substantial penalties indeed. It's a draconian regime, and it will also place responsibilities on people who purchase avoidance schemes from high-risk promoters, and therefore HMRC's belief is likely to run interference in this particular area. We now move on to two of the perhaps more worrying developments, and the first of these is what's called a follow notice. And a follow notice will be issued to a user of a scheme where HMRC has been successful in litigation. Now, this was subject to quite a short consultation, and quite a lot of concerns were expressed about the measure, but we'll have to await the final form of the legislation, the finance bill, before we can comment in any detail. But here are the areas that you might like to think about. First of all, is it sufficient HMRC wins at tribunal, either the first tier or the upper tribunal? And exactly how are the other users of similar schemes to be identified? Will it be confined to those who are just using a scheme with the same scheme reference number? Or do HMRC intend to wrap in other similar schemes based on the same logic? So we'll just have to wait and see how that pans out. Now, if you are in receipt of a follow notice or a follower notice, what you will be required to do is to revise any tax returns that are still in date to be amended, and to make a settlement with HMRC of the money at stake, both for the amended returns and any earlier years. However, it isn't mandatory, and HMRC, although using that to persuade people to settle, don't have the legal right to enforce these liabilities. So if a user decides to go to court and fight their case, then they may not make the amendments, they might not pay the tax under dispute. If they are eventually unsuccessful in their court case, they will see additional penalties arising as a result of not complying with the follower notice. So all this is doing is really upping the ante on people who want to continue to pursue a tax avoidance scheme that looks as if it might be a little bit dodgy. Turning now to the second of these measures is something called accelerated tax payment. And for anyone who buys into a numbered scheme from Royal Assent, or any scheme which has been defeated, and any scheme which is subject to challenge under the GAR, the taxpayer will be required under self-assessment for both income and corporation taxes to pay the tax that they believe they have avoided by the use of the scheme. So that will become a legal responsibility. So you can see the distinction with the follow notice. You'll have to pay the tax, and I think HMRC's judgment call is that if you've got to pay the tax up front anyway, you'll be less likely to buy a scheme which has got costs associated with it. If you pay the tax and you decide that you want to pursue the scheme, then you will obviously be faced with making a challenge to HMRC, forcing the issue through the courts, which may of course cost you additional funds to actually pursue the case. So the exact mechanism as to how all of this will work out, again, we'll see in the finance bill, but it is an area of substantial challenge. Bear in mind that a lot of tax avoidance schemes now sold only produce a delay in paying tax, and you can see why HMRC would think that this is the right way to go about defeating avoidance on a large scale. Well, that's the end of my comments on the measures on anti-avoidance in the Budget and Related Material 2014. This is one of a series of lectures on the subject of the budget, and I hope you found it useful. Thank you for listening.